From the morning reading, broad index ETS pull back on below average volume. Financial sectors are lower. Breadth weakened compared to the prior session as decliners led 1659 to 1352 on the New York Stock Exchange and led 2008 to 820 on the Nasdaq. On the S&P 500 snapshot, another lackluster session as we approach the inauguration. The S&P 500 sank at the open to a morning low about 15 minutes into the session. A buy the dip trade promptly lifted the index to its negative 0.11% intraday high, after which it traded in a narrow range to mid-afternoon sell-off to its negative 0.52% intraday low. Another round of dip buying trimmed the loss to a negative 0.30% at the closing bell. Financial stocks have been dragging. Over the past month, financials have been consolidating after large gains after the election. Their drop on Monday was enough to drag them to a one-month low, yet the broader indices like the S&P 500 remain within spitting distance of multi-year highs. That seems like an encouraging sign, but the last two times it occurred were in 1999 and 2007. Small caps are lagging again. Like the financial sector, the small cap Russell 2000 dropped to its lowest point in over a month on Monday. When it does so, while the S&P 500 remains close to its own high, the Russell has averaged a further decline of more than 7% at some point over the next 3 months. Black swans are on sale again. We touched on this on August the 19th of last year, after which the VIX jumped 60% during the next month. The same ratio of skew to the VIX just flashed the same level of extreme, suggesting there's a disconnect in how protection is being priced. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends and market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 18th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and jump into the morning report. And at the time of this cut, all four of the U.S. broad-based indices were up just above scratch. Crude oil, though, is moving pretty significantly, down about 1.5%. Euro's down about 0.5%, as is the long bond. Gold is down just below scratch. In our overseas markets that we watch, in Asia, China's up just above scratch. Hong Kong up over 1%. Japan up almost 0.5%. Germany's up just above scratch, as is the United Kingdom. So most of our primary markets are hovering just above scratch. In terms of macroeconomic reports for today of note for the United States, you have CPI, capacity utilization rate, industrial production, housing market index, FOMC member Kashkari speaking, Fed Chair Yellen speaking after the market closes. And then looking forward to tomorrow, we have building permits, Philly Fed manufacturing, the weekly unemployment claims, housing starts, nat gas storage, and crude oil inventories is flipped from Wednesday to Thursday this week. And you also have Fed Chair Yellen speaking again after the market closes 2 days in a row. In terms of current volatility conditions, you have short-term VIX has moved up a bit, 10.85. Skew still up over the second threshold of 131.55. And you heard one of the morning authors made a mention of this skew as well, and about the black swans being on sale again. And then when we've had these conditions in the past, you've had quite a pop over the next month. So there's something to be said about watching the skew. You hear us report it each day, and what we're looking for is a start of a movement, a change, and especially when you have this really low volatility, when you start to see the skew start to climb, it's telling you that there's movement on the extremes. The skew looks at the way out top side and the way out bottom side. It looks at those extremes in that pricing. And we're starting to see where people are starting to nibble on some rather extreme parts of the volatility. And oftentimes this is a condition that comes together to see an increase in volatility. And we'll talk more about this when we get to the specific indicators of warning, but take note of that. Also, we take a look at this IV percentile, and the reason for that is that when you get extreme one side or another here, you often see a reversal, and certainly we've been extreme. You can see these are all red. That means they're down here in this lower section. IV percentile for the S&P right now only at 11, so that means that its current implied IV is lower than all but 11% of all trading sessions in the last 52 weeks. And the same thing for the Russells of 22, the NASDAQ at 10, the Dow of 14. We did have a standard deviation size move put in yesterday by the Russell, and you notice here, after being so strong for so long, the Russells had 2 -1 standard deviation moves in the last 2 rolling weeks. Now, along with that, we've had a +1 and a +2, but we're starting to see some volatility really pop here, going both directions in the Russell, and it's probably the one where there's the most potential profits to be locked up from the recent moves, depending on when people got into those moves. So if things start to roll over, they're going to want to protect. The same thing in the NASDAQ. NASDAQ's been doing well of late, and they're going to want to protect if they're in one of those holdings. Now, NASDAQ's move was rather narrow, not a lot of breadth to it, but if you're holding one of those stocks that was the big part of the NASDAQ move, you're going to want to protect those profits if things start to become jittery, and those weak hands will be the first ones to let go, and then that will precipitate potentially a further correction as the selling begets selling. So these are the kinds of things that we look for as change and rate of change, and a reversal and the and elevation in the levels of risk that are present in the market. So real good examples of kind of the tea leaves, as it were, that we're looking for at the beginning of this process. Okay, let's go ahead and go to the charts. Okay, here, let's take a look at the S&P futures, and you see we've been in this sideways consolidation pattern. Of late, though, you had this undercut here, but, rebounced during the day and ended up right back into the range. The next day, back to the top of the range. Now, yesterday, back to the bottom of the range. We just continue to bounce in this really small, about 1.5% range between the tops and bottoms here, roughly. But until we actually break out to the top side or make a real break to the bottom side, it's just noise, and that's where we are right now. This noise may continue all the way up to the election. I've heard some theorizing that either at or after the election, we might see an increase in volatility. Now, it's always interesting when you hear people say something like that. Well, if we're really going to see an increase in volatility, then you would expect that the market makers would have priced that in. And when I look at the S&P and we look at volatility here, I don't see anything extreme. There's a general increase in volatility, ranges over time, but that's as you would expect over time. For example, next week, is there a big pop and implied volatility? No. So, it's interesting to hear those comments, and they may very well be right. but certainly the market makers have not priced in that expectation. So that's something, I kind of put in the back of my mind. Every time I hear somebody say something like that, it's like, oh, we're going to be down 15%, in the next week or something like that. It's like, oh, okay, well, let's see what volatility the market makers are pricing in. Are they expecting to have an increase in volatility? Well, more often than not, when I look, there is nothing there. And that tells me that, maybe somebody's filling some airspace, and there's just really not the probabilities that would seem to be there. Now, sometimes there's real reasons behind an expectation and an increase in probability of volatility, and that's because we got some macro report or some big decision or some election or vote or something like Brexit or something like that coming up, and you expect that there would be volatility associated with that event as that event then becomes priced into the market. But right now, other than an inauguration, which everybody knows exactly when that's going to happen and the time and date, other than that, remarkable, peaceful transition of enormous power from one person to another that we experienced here in the United States, there's nothing really special about an inauguration in and of itself. Now, obviously, after the inauguration, we begin the first 100 days, and we'll start to see real policies and real changes, perhaps impact certain markets and certain industries, and that could be the cause of the increase in volatility. So we'll have to wait and see just when that starts to move. And the other piece to this is that certainly with this kind of big post-election move, this bit of consolidation to the sideways that has been going on for now over a month, do we expect that we're going to get, some increase in volatility at some point? Absolutely. And we've been watching for that here for some time. But that doesn't necessarily mean that we're going to get a drop of, some 10+% correction. Now, as the situation develops, we'll certainly watch for that. NASDAQ also has been in a sideways consolidation, though a much, much shorter, much more measured in just a number of days instead of weeks, like the S&P and the Dow. In terms of the Russell, of course, has been, was the strongest, most recently taken over by the NASDAQ. It is wanted to show a sideways consolidation for sure, but I think if you start to take a look at this, and you'll see there's a subtle downward drift in this sideways consolidation pattern. And that subtle downward drift, we start to see, a lot more days near the bottom of the range than we do near the top of the range. And, the last time we were near the top of the range is now, what is that, over 2 weeks past since we have really kind of pushed the top of the range. And that was that interesting kind of 2 standard deviation move up that was immediately followed by a standard deviation move to the downside. And ever since that pattern, we haven't really gotten more than halfway up through the trading range. So this could be the first to break to the downside and truly break down. So we're going to want to watch for that action. And then let's take a look at some of the other markets. Crude oil, of course, has had some volatility of late, pressing both new highs, new recent 52-week highs, as well as undercuts below its sideways trading range, though right now it's smack back into the middle of its trading range. Then you have gold. Gold, of course, made big moves with the recent dollar moves, much of this fueled by Trump making comments about the value of the dollar and so forth, and that certainly sent a shiver through that market, and gold continues to benefit from that. And then you have the long bond. Bond has moved up, but then recently went into a sideways consolidation pattern, bumped right up against the bottom of the Ichimoku cloud, which would represent a resistance area. So we'll continue to watch that as well. And then, of course, the dollar itself, you see that big move that you had yesterday on the Trump discussion. That's retraced a bit today, but you notice even after the retracement, we're still well down from the recent closing lows. And let's take a look at volatility itself. And of course, while we continue to see a little bit of a pop here and there, it's just a small, and this pop yesterday did just barely brought us up into the 12 handle just to close down, and then it ended up closing below the 12 handle, and we continue to operate below the 12 handle. So very, very low volatility, being a sign of complacency, very much extreme complacency in the marketplace at this time. Well, I think that's probably enough on the charts for today. Let's go ahead and go to the daily report. And some important changes here. We've first of all, we just barely tricked over, but in the intermediate term phase opinion, this has given us a bearish signal. Market phase 5, the end short term, the break of diagonal support is the description. And this came with the S&P's close yesterday, just barely triggering this. So within the context of the rest of the indicators, we still take this as a minor warning signal, but its importance could elevate if we start to see that change and rate of change start to wiggle through the rest. So think of this as an early warning shot, and we're starting to wiggle our antenna just a little bit more sensitivity now, and we're starting to watch if indeed we start to see an acceleration of these types of signals start to come into play. In terms of the primary market timing signals, and these are largely based on an intermediate term trend, IBD is the first source, and it still has a confirmed uptrend. GMI index, also a source and mechanical in nature as well. 5 out of 6, that buy signal has been in place since 11:10. And then stock charts decision point, of course, no changes there from yesterday. We still have these mixed signals on the short and long term. Overall consensus of these three market timing systems, or a consensus to the bullish side, albeit a kind of weak kind of bullish expectation. Position sizing opinions both at 100%. Intermediate term market posture, an exceptionally strong bull, and that's supported further by an exceptionally strong bullish sentiment line. But do note, Russell, again, been oscillating, been going back and forth, but continues to show some relative weakness, and right now is in a signal area of weak bear. So that certainly is not a super strong thing there. But, we don't want to ignore three exceptionally strongs just to talk all about weak bear on one. This is, a minor warning at this point, and we'll see if it starts to build. If you start to see the S&P and the Dow drop below the 80 and also become weak bears, then that change and rate of change starts to accelerate, and we start paying increasing amounts of attention to this. Generally, markets that roll over and go into corrective modes, whether it's just a pullback or something more significant, don't do that just in one day, and don't just have that happen, in quotes, out of nowhere. Usually there's a kind of increasing level of degradation that builds on itself. And we may be seeing the very first signs of that. But right now, these are very minor and early signs of that potential. In terms of the hedge warning status, we're still 0 plus, normal with some elevated conditions, so nothing has even triggered this to move to a 1 as of yet. In terms of strategy opinions, the VIX is still below the acceptable range to initiate new positions. We do this whenever the VIX is below a 12. The amount of premium that you're taking in versus the amount of risk that you're taking on is a bit skewed and maybe too much to handle for novice traders. Cover calls, put selling, both are in positive positions for the initiation of new positions for novice traders' opinion. In terms of specific areas of warning, I did want to speak to this just a little bit more today. We've had a situation in recent days where we've had these kind of various warnings that are related to an expectation of the increase in volatility. They're still all there. But now we're starting to see, some others start to pop in. And we've got this distribution day count, which had slowly, albeit very, very slowly, been falling down from about a 9 on the NASDAQ down to a 5. Well, now it's started to increase again, and it's back to a 6. And the S&P has now gone into warning status at a 5. We talked a little bit about skew earlier, and one of the morning authors talked about skew, and that's now, of course, up over 130. It's got about a 10% probability of a 2 standard deviation move in the next 30 days. Also, in terms of the trend-based area, with that market phase 5, that first kind of minor warning coming in, and that's kind of starting to change, the tenor across this section. We, of course, have been looking at the key intermarket risk aversion indicators, and they never, in recent trading sessions, got to where they were all positive. At times, we had all 5 of these as risk off. Well, this one that was risk on is looking like it wants to roll back over and re-signal risk off again. So we continue to see some areas of warning from here as well. From a sentiment standpoint, relatively neutral, just above the neutral area, coming in at a 57 on the fear and greed index. So you put all these things together. These are all, at this point, very, very minor warnings, but we're starting to see that kind of subtle increase in the warnings and the subtle increase in the rate of these warnings coming across the tape, as it were. So, we're still 0 plus on our hedge warning status, but we're starting to feel like there's some of these tea leaves are starting to kind of line up and starting to point to an increasing level of warning. So not going to be a bit surprised if we get a bit of a especially a shallow pullback, perhaps something 2 to 5%, would not be a bit surprising. Now, if that were to go something bigger than that, once you start that process, it sometimes builds on itself and builds its own energy, especially after having had such a huge move up in the post-election period that we would retrace, some percentage of that would not be a bit surprising. So we'll have to see if we do get this pullback, just how far it might go. And, for some people, it could very well be nothing more than a buying opportunity. It depends on the time frame in which you're focused with your trading and investing. Okay, let's go look at some sector-specific information. Now, of course, yesterday was a bit weak. The overall S&P was down about 0.25%. And look at who was doing well. The defensives, consumer staples, utilities, real estate, telecom. All of our defensive sectors are here as the top 5 sectors for the day. And then at the other end, the financials, significant drop yesterday in the financials. We continue to see some of the financials report their earnings. And, on balance, some of the important earnings yesterday were not helpful to the sector. Industrials, materials, information tech, also risk-on sectors were largely with poor breadth and falling valuations. We started to see some further deterioration, especially in the short to intermediate term, across quite a number of the sectors. So let's take a look and see who's holding up the best. Telecom, consumer discretionary, now that's a risk on that's still holding up. Utilities, technology, another risk on. So we got 2 kind of risk on and 2 more defensive areas of the market. Utilities and telecom, both looked at as kind of dividend paying places to go, relatively defensive, but still consumer discretionary technology. This may be more a reflection of that they were doing so well and, perhaps need a few more days before they start to see their postures break down as those signals start to fall. They have farther to fall before triggering after doing so well. And indeed, if we look at this performance, and we're starting to see so many of these in this, 1 day, 5 day, bleeding into 1 month that are negative performance. Most of these were doing pretty well in the the more intermediate term after that post-election rally, that's starting to see some erosion as we start seeing the lower edge of these trading ranges more and more frequently and across more and more of the market. So that's about enough for today. We've hit 25 minutes, which is definitely long, but I wanted to really dial into a couple things today. There were some things that were definitely becoming more and more interesting, especially if you are like me and you have a mind towards, risk evaluation and market condition, market posture of the markets, and you like to make decisions on your investing and trading based on being in alignment, what I call the prime directive, being in alignment with the current market condition with my trading and investing activities. So disclaimers as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink at the bottom for the full set of disclosures. We'll be back next for tomorrow's session from Falcon Global with the market preview session. In the meantime, manage that risk and seek to learn something about your trading and investing each and every session.